Inheritance tax, or IHT to you and me, do you need to pay it? And when do you need to pay it? Well, those questions will be answered in this video. So we need to worry about inheritance tax. So how much money can you inherit before you pay inheritance tax? Let's talk about what inheritance tax is before we crawl straight through the details. What is inheritance tax, please?
So inheritance tax is HMRC's method of sadly grabbing you beyond the grave, so to speak, and making sure that whatever your worldly assets were worth at the point of your death, a tax is paid based upon their value. There are some carve-outs and exemptions, which is good news, and we'll maybe talk about those depending upon the questions. But broadly, if your worldwide and ownership of assets is over a certain value, then you're likely to have your estate have to pay out 40% in inheritance tax on everything above a certain value. And it's a tax that is genuinely taxed on the person who has died, and it is administered, of course, they can't do it once they're gone, bless them, but it's administered by typically someone called an executor, who will be identified prior to the person's death in their will, determining who is going to sort out all the administration and make sure all the assets are actually handed over to the right people. It's going to be their job to work out how much tax is due, to work out what assets they're going to either have to sell or what cash they're going to have to use to pay that tax. And then whatever is left over is then going to be shared on with the beneficiaries of the will. So the people that potentially you want to inherit all the items that you will have at your death.
And in terms of inheritance tax, how much people are paying percentage-wise of, let's ignore all the exclusions.
Sure.
If you've got £100,000 that's over and above the exclusion amounts.
So in other words, it's going to be taxable.
How much are you paying?
Well, sadly, and I think I might have said this already, so I do apologise, 40%. So for example, for every £100,000 that's going to be taxable under inheritance tax, kiss goodbye to £40,000. A lot of money.
And the reason why I want to highlight this is because people do focus on very much about growing wealth. And they say, well, I'm building my assets up in order to pass it on to the children. But as Chenji Meng, who is on the panel members for HK to UK, which is coming your way this Thursday at 3:30 p.m.
He couldn't help plugging it, could he?
Yeah, I just couldn't help plug that. So if you're from Hong Kong, you want to know about tax and law, then make sure you join us on Thursday. But apart from that, one thing he did say was, if you're raising an asset base or increasing your wealth by £100,000, make sure that you include Uncle HMRC into your will.
Yes.
Because that's technically what we're all doing if we're not careful. So it's one of the key things. And I frequently have these conversations. You know, I had one today, I had one last week. I'm going to have one every week, I have no doubt, about inheritance tax. And the one thing that I always say, it's based on net assets. So one of the things that you could do, a couple of things you can do. One, increase your debt, because debt brings down your net asset value. And because of that, you will pay less inheritance tax. But hark, you then have cash instead of in terms of assets. So you've not really done anything unless you spend all that money. So the other side to it is gift your assets to your children.
Whilst you're alive, maybe.
Whilst you're alive.
And they can enjoy it with you.
But then what tax have you got for that?
Oh, that's when capital gains tax triggers. So for me, whilst you're alive, if you try and give some assets away, then you're caught often by capital gains tax. But the tinker that HMRC is gets you when you're dead, because actually, if that's the point you choose to give your assets, well, capital gains tax, that doesn't apply anymore, because that only applies to living, breathing people. But now you're passed away. Instead, we'll get you with inheritance tax. Here's the kicker. Capital gains tax at its highest rate is 28%. And that puts a lot of people off from gifting. And I get that, completely understand that. So would you prefer to have your family inherit 40% less of your assets or 28% less of your assets? Big question.
Well, there is a debating point, though, Louise, in terms of saying that someone gifting an asset paying capital gains tax does it reduce your IHT? Let's say that you pay your CGT 28% if it's a residential property.
Sure.
But you die the following year.
Ah, now this is where HMRC still gets you. Depending upon who you gave that asset to, if it was somebody connected to you or in your family, there's a very strong chance that that's still going to be caught by inheritance tax. And you may have heard of the 7-year rule. What the 7-year rule says is that if you were to gift an asset to somebody and get nothing in return, yes, you might pick up capital gains tax at the removal of the asset from your estate. But actually, after 7 years, it's technically not possible for HMRC to claw that money back and put it subject to inheritance tax. If, however, you pass away within the 7 years in which you gave the gift, then depending upon how long ago it was you gave the gift compared to when you pass on, will determine how much is still caught by inheritance tax. And this is the nasty. So to Simon's example, in the first 3 years after you gift an asset away in your life, if you die in those 3 years, your inheritance tax item on that particular thing is still probably 40%. If, however, you die year 4 after giving the gift.
Well, can we just stop there? Because I think it's really important for people listening in to understand the intricacies of capital gains tax and inheritance tax. So let's imagine that you've gifted away an asset and it had, I don't know, it was worth nothing and it's now worth £100,000. So we're talking about shares as for an example.
Okay.
But it's still worth £100,000. It was worth nothing. Now it's £100,000. You had a gain. So the person gifting it pays 20% tax because they're a higher rate taxpayer. That's capital gains tax. So £20,000.
20% because it's shares, not property, just in case you were going to say, but hang on a minute, Simon, it's 18 or 28.
As a high rate taxpayer for sure. But let's focus now on year 2. They died.
Okay.
Do they get a credit for that CGT?
That's a great question. What do you think, guys? What do you think the answer is going to be?
Because it would sound fair if you paid, if your asset was bought in, you paid capital gains tax, but then the asset was bought back in, you got £40,000 inheritance tax. You've already paid £20,000 CGT, so surely it's only fair to get the credit.
In most cases, you will get an element of credit. So that's the good news. There are some situations that you won't, and I'm not going to go into that level of detail on this particular webinar. But the good news is there is an interplay between capital gains tax and inheritance tax, depending upon how soon those two triggers of tax were caused.
But you do need to be very, very careful, because some people say, well, make a gift of assets to reduce the tax that you pay through gifting. But if you, and I had a call very similar to this today, whereby the first person was quite terminal and they asked, should I make gifts? And I said, well, it's unlikely you're going to benefit from them because it's going to be brought back in. You're going to be hit with this 40%. There's a potential where you don't get the credit for the capital gains tax and therefore you pay 40% as well. And you have to be very careful with how things are planned out with your estate. So always be very, very careful with that in mind.
The other thing I would say as well as to in a terminal situation, which is a really sad place to be, and I'm not going to dwell on this because we've got lots of other things to help you with regards to inheritance tax. But sometimes, to Simon's point, it's better not to gift the asset because, would you believe it, inheritance tax in certain situations is payable over a 10-year period. Yeah, you heard it here. You can actually pay your tax bill over 10 years when it's inheritance tax for certain types and categories of inherited item. Capital gains tax, of course, though, is now payable in certain circumstances within 30 days of completion of sale. And of course, sale in the example we're talking about might be no money changing hands. It's a gift. So actually, would you prefer to pay your tax in 30 days or over a 10-year period? The choice is yours.
A very interesting point. Second question that's related, and I'm just going to put them all together into the relation. So here's the second question. Gifts. Okay, so
yes,
gifts. Please. Yeah. You haven't been a good girl.
Oh.
Gifts. Do you get gifts and in your lifetime? So Louise talks about making a gift during lifetime. What happens in that gift scenario and how do you calculate it? Because as Louise said, during your lifetime, If you make a gift within 7 years, then it could be pulled back in. You may or may not have paid capital gains tax. So let's say that you gifted away your home, well, you wouldn't have to pay capital gains tax because of private residence relief. So that's sometimes a good way to maneuver. But let's imagine, Louise, that someone's made a gift in year kind of 2000. They passed away in 2004. I know we're kind of going back in time, but my simple math, it works.
Keep going.
What happens in that situation in terms of people from YouTube now thinking, crikey, have I just lost it? Have I gone back in time? Back to the future. Yeah. But what happens? I mean, someone's just made a gift for 4 years ago. Who should have recorded that gift? Do you notify HMRC of that gift? And how does it come into the equation of IHT?
Oh, lots of questions there. So
let's hope you've got some good answers.
I'll do my best.
Yeah.
So if the gift is not an exempt gift, and I'm not going to jump into lots of detail on what an exempt gift is because there's lots of interpretations and conditions and details. But imagining it is not an exempt gift, it is the responsibility of both the donor and the donee, so the person gifting and the person receiving respectively, to keep a record of what they were given, how much it was valued at the time it was given, and the date it was given. It's an expectation, and it's not written down anywhere that I know of in normal day-to-day activity, unless, of course, you're checking the HMRC website on a daily basis, which we do because we love it. But it's expected that the donor, so the person giving the gift, should capture this in writing somewhere that would be accessible by the executor of their will and their estate, so that they can take that into account when they're looking at the tax to pay, the estate, and what to include in the estate for valuation purposes. So you heard it here first, guys. If you're giving things away, it really is incumbent upon you to keep a copy of those documents. But I cannot tell you anywhere that you would see such logical common sense written other than on a HMRC fact find.
The one thing I would say about all of this is mum, dad gives some assets away and they appoint an executor. An executor, my understanding, is a legal responsibility. Mm-hmm. So the person is similar to a trustee. If the person nominated and they may not even receive any of these gifts, but if it's found that the person, the parents were gifting stuff through, and technically speaking, you are the executor or you're the trustee, you should know about these financial transactions that goes on. Could HMRC, the eye of Sauron, look upon you and burn you to the ground? Because technically speaking, you are a legal responsibility. So do be always hesitant when anyone says, would you be my executor? Would you be my trustee? Be very careful, because I think you've got a lot of responsibilities that you may not have any benefits at all from this estate, and yet you could be penalized. You could face a fine. And I think there's a challenge where the HMRC can actually go for you if there's no tax.
Yes, they can, because arguably you're in control of the estate. So I would always say to somebody who has been asked to be an executor, either to family or friends, you know, it's an honor and it's a massive responsibility. Do not say yes lightly. Go and research the responsibilities you have, both legal and moral, and go and be certain you can actually perform those duties to the letter of the law before you absolutely say yes.
There are many live events that you can register for free. There are 4 events that's showing HK to UK to help people move from Hong Kong to the UK. The Property Expert Panel. If you're a property investor and property developer, this will be very useful for you. Tax Q&A, if you want to ask proactive tax questions in regards to structures and how to mitigate tax in the future. And finally, UK tax return Q&A, as it says, to deal with questions in relation to your tax returns before you submit it to HMRC. Don't forget that these events are live and will be shown on YouTube the day after. So why not register today, start saving tax tomorrow.